All right, guys, welcome back to the Independent Investor Channel. Hope everybody's having a great day. This video is going to drop you into M1 Finance, and it's going to walk you through a portfolio that I've built out of the 11 sectors of the S&P 500. You guys are going to enjoy the angle that I'm taking by utilizing this strategy in M1 Finance to take advantage of the portfolio redistribution of funds. And I'll explain that a little bit as I walk through the portfolio. This is a rather uncommon way of investing. I'm up about 20% in the portfolio. It's extremely diversified. It gets me broad exposure to all of the sectors in the S&P 500. And I think it's a little bit experimental in nature, but hey, we're making real money on the experiment nonetheless. So I'm going to kick you into M1 Finance now, guys. Please enjoy the review. All right, guys, I've taken the liberty to drop you into M1 Finance account. This is one of two accounts that I have with M1 Finance. This is a completely different strategy in this particular account. This we built really to help investors understand how to break down barriers to entry. A lot of investors really get overwhelmed when they start. This was started with a fairly conservative starting amount in this portfolio. It's funded with $25, I think, every couple weeks or so. I was trying to emulate what a dollar cost average schedule would look like for a new investor, and just really kind of track the progress for folks that are following this. To see, you know, in realistic terms, how long it would take to get up to that first $10,000 of invested capital. I think that's a realistic goal for any new investor, how to go from zero to that first $10,000 goal. But I'll point out a couple things in this M1 Finance portfolio. This was probably the most exploratory of my accounts that I had, in that I really had never invested in the sector specialty ETFs. And I know that's a mouthful, but for you guys that are beginning investors, basically what I've done is taken the 11 sectors that are represented in the S&P 500. A sector is denoted by either technology, healthcare, financials, consumer discretionary, consumer staples, telecom sector, utilities, materials, energy, and down the line. And what I've done is I've taken the 11 sectors and, using the Vanguard's sector specialty ETFs, they're commonly referred to as spider ETFs, because when you invest in, let's say, the technology ETF that I have here as my largest holding in this portfolio, at 14% of target allocation, this is going to cover the entire technology sector. So just for a sec, I'll click in here and actually show you how this breaks down. It's really quite interesting. And then we're going to view VGT details. This is really informative. I really like this aspect of the M1 Finance. It really shows you how it's broken down. Obviously, the top holdings are Apple and Microsoft. But if you didn't know, 98% are held in the U.S. equities. So basically, the technology sector of the S&P 500, it actually has 320 total holdings in technology, and it's spread across stocks of large, mid-cap and small-cap companies within information technology. So just to give you kind of an idea, the fund does render a small dividend. Not typically why I would invest or have this portfolio heavily weighted to technology anyway, but nonetheless, we're taking 1.05 of a small dividend anyway, stipend to own that particular fund, so I'm happy to do so. We kick back here to the home screen. It was up 19% earlier. I don't know if they refigured a little bit and it dropped just a little bit below, but 18.99%. We've owned the portfolio since March of last year, so just a couple months away from owning this for an entire year. This really is set up as a passive investment strategy. So unlike the dividend investment strategy, or the aggressive growth strategy, this is set up to be 100% passive in nature. I do not rebalance this, nor do I ever recommend rebalancing a portfolio in a taxable account. You run the risk of creating taxable events when you do that. So you want to be careful in M1 Finance. I wish they would just remove that function altogether. It's unnecessary to have in a taxable account. But in a Roth account or an individual retirement account, you can rebalance until the cows come home, until you feel like that's what you want to do. But I really haven't found a whole lot of need to continually over rebalance this portfolio. Keep in mind, as fundings do flow into this, they're flowing to the lowest held of the sectors that I have in my pies. So I've got the 11 here, denoted in the traditional M1 Finance style of displaying your investment sectors in way of a pie. I think that's a simple way of doing it. It appeals to a lot of investor, but we're closing in on 3,000 in total value here. The capital appreciation in this portfolio is 334.67, and then we've got a little dividend stipend here of 41.13 on this particular portfolio, which is fine. Again, dividends are not the primary goal of this. Passive income is. And so we're just abiding by a very strict dollar cost average schedule. What that means is I take $25 every couple weeks and I put it in here on a schedule. I don't worry about it. It goes into this account and it funds it as appropriate. If it goes up, it goes up. If it goes down, we buy more shares. So what do I always advocate for in the stock market? You don't have to make this thing like rocket science. You want to win in either market, and the diversity is in this portfolio. There's no doubt in my mind. There's a lot of holdings that are represented here, and the cool thing about the way that I have this set up is that I've been able to weight the sector that I want at the top end here, which is technology, which I guessed perfectly fine. It's up almost 40%, so it's returned quite well. I wish I had more money in it. Not that great of a return as far as the dollar goes, but as far as performance, that's great. One underperforming sector thus far is no surprise. Energy has really just been a laggard. It's continued to be a laggard going into 2020. I do feel like that's going to turn around at some point, but we're not holding our breath. That's fine. So some of the new fundings that are coming into this portfolio, some of the dividends that are rendered off of this portfolio are going to fund the under-allocated sectors in this portfolio. And that right there is the strategic goal of this portfolio. It was meant to establish the opportunity for portfolio redistribution of funds. So anytime a distribution is paid to this in way of a dividend or a funding flows into this account, it's going into the lowest cost asset. I really like that opportunity, guys. If you just sit back and think about what strategy I'm looking to deploy here, this is not rocket science, nor have I found a cure for a rare disease here. This is just something that seemingly fit with M1 Finance. And this little hypothesis that I've drawn up here, putting these funds to work in this manner, is absolutely working, and it's leveraging the opportunity of the portfolio redistribution with M1 Finance, and it's only made possible through M1 Finance. You're not going to get this opportunity with other brokers out there. M1 Finance has portfolio redistribution, whereas most of your other brokers are going to offer a dividend reinvestment program. The difference being is if you held an asset like this and it paid that 1.05 dividend that I showed you guys earlier, it would go into funding the underlying asset. In other words, the one that actually paid the dividend, it would roll back in to fund that. The way this works is any new funds that roll into the portfolio are distributed to always try to hit that target allocation that we're at. So we're a little underweight healthcare here at 13% being the target, 12.9 being the actual. Down here, energy, we're lagging a little bit at 6.5, the target being 7, and so on and so forth. We're a little overweight telecom communication, a little underweight materials. and so be it. Those will fluctuate over time as the underlying equity appreciates and depreciates in value. But I just love that opportunity of basically mediation in this portfolio. I just love the idea that as new funds flow in here and as this portfolio really has a chance to mature and grow over time, it's really going to be awesome to see how those fundings are always going to fund the lowest sector within the portfolio. Why do I say that? It's because not all the sectors perform at the same time. You're going to have what's called sector rotation, where technology is going to outperform. And listen, when somebody wants to take profits out of here, or big hedge fund managers want to pull profit out of technology and start to take another bet on energy, energy is going to quickly start to outperform, and then energy or technology will start to underperform. And that's considered a sector rotation. Well, they'll take profits from a healthcare sector and maybe roll it down to one of these other underperforming sectors like materials or industrials, something of that nature. And I'm going to always benefit from it because I have exposure to all the sectors. And when I built this, the final thing I'll mention is that I built this to have exposure to all the sectors. I didn't want to leave one out. If I left one out, that would be the one that outperformed. So I figured I would get exposure to all of them, but then control my allocation in a weighting that made sense for me. Technology being the highest weighted, materials being the lowest weighted, but I have exposure to all 11. So guys, thanks for tuning in to this M1 Finance tutorial of the Sector Spider ETF portfolio. We're going to continue to monitor this, and I'll continue to roll out the updates as appropriate as we march toward that first $10,000 goal. So with that, I'll kick you back to YouTube. Thanks again. All right, guys, welcome back out of M1 Finance. Really hope you enjoyed this specialty ETF review. Obviously looking to leverage the opportunity in M1 Finance for portfolio redistribution of funds. I think the idea here is that while some sectors will perform and others will underperform the market, the idea is to get broad, diversified exposure. So I'm making sure that I'm catching all of the appreciation that the stock market has to offer. And I like the idea of controlling the allocation that I set over it. For example, a little bit more of the money goes toward technology and a little bit less money goes toward materials. So you can kind of invest and weight the portfolio in a manner that suits you. I really think that's a great option for new investors. This is a really fun portfolio. It's a great way to invest. It's going to give you some dividend income to boot. And then I fund this account up with about $25 every couple weeks. So I've got it set up on a true dollar cost average program for your guys' knowledge and how I'm building wealth in this one particular account with M1 Finance. But please understand, the Independent Investor channel provides these links to all new investors in the description of each of my videos. If you do click on the links, they are affiliated. Independent Investor channel is affiliated with M1 Finance. If you do click on any of those links and opt for their service, the channel can receive a small compensation for you opting for the services, guys. So if you're new to the channel, please subscribe to the message, leave your comments at the bottom of the video, and share the message with anybody out there that you know can benefit from the information. And again, on behalf of the channel, thank you so much for tuning into the message, and good luck in your investment future.